Thinking of selling your business in the next year or two? Here's something you'll really want to know. The tax on selling your company could jump by 40 grand or more after April 2026, just because of a timing change in business asset disposal relief. Let me explain what's changing and how to protect yourself. BADR, or Business Asset Disposal Relief, is one of the best known tax breaks for business owners when they sell up. But from April 2026, the government is tightening the rules and increasing the rate, so careful planning becomes essential. Quick refresher, BADR, formerly Entrepreneurs Relief, offers a lower capital gains tax rate on qualifying disposals of a business or qualifying shareholding, subject to certain conditions. For sales on or before the 6th of April 2026, the BADR rate is 14%. From the 6th of April 2026 onwards, sales qualifying under BADR will be taxed at 18%. The lifetime limit for gains that can qualify remains at 1 million. So it's only the first 1 million that falls within BADR. So what's really changing? What have you got to watch out for? Well, there's a higher effective tax cost. So because the BADR rises from 14% to 18%, the tax saving shrinks quite significantly. Disposals made on or after the 6th of April 2026 will see the higher rate applied. Anti-forestalling and timing rules for contracts. To protect taxpayers from locking in the local rate by premature contracting, there are also anti-forestalling rules. If an unconditional contract is entered into in the 2025-2026 tax year and completes on or after the 6th of April 2026, the disposal could be treated as happening at completion for the purposes of applying the new rate, unless it qualifies as an excluded contract or a claim is made. That's really important. When we saw the tax increases last year, we saw a lot of people trying to contract before the tax year, but have it take effect after. This would prevent that. Also, disposals via connected parties or where timing is clearly tax motivated are likely to be scrutinised more by HMRC. Then we've got strict qualification and HMRC and tribunal scrutiny. The qualifying conditions, so the personal company test, holding period, being an officer and employee, having trading company status, all remain critical for BADR to apply. Recent cases show that HMRC are strict about whether a company is truly trading versus mixed or a property investment company. Mistakes in timing, for example, just missing the holding period or changes in business activity, can derail relief being applicable. So what should business owners do now, and what are the action steps you should be taking? First of all, review your exit timing. If you're already planning a sale, assess whether bringing it forward while the 14% rate still applies is feasible and if it makes commercial sense. Check your qualifying status and compliance. Confirm whether your company meets the trading test, whether your shareholding and voting rights meet the personal company test, and whether you satisfy the 2-year holding period or the officer-employee test. Plan your contracts carefully. If you're entering into sales agreement prior to the 6th of April 2026, structure them to reduce risk of anti-forestalling applying or consider making a claim for them to disapply. Model tax impact under both rates. Run financial scenarios to see the tax cost difference at 14% versus 18% to inform your negotiation and your planning. Document motive and commercial rationale. Keep contemporaneous records explaining why contracts or transactions are entered into when they are, to defend against claims of tax advantage motive, just in case HMRC ever challenges it. And seek professional advice early. Engage your tax advisor, engage your legal advisor now. Don't wait until just before your intended exit. So just to give you an example, let's say Alice holds 100% of shares in the trading company. She qualifies for BADR. She plans to sell mid-2026. Under the 14% rate, if it's done on or before 6th of April 2026, on a 1 million gain, her tax is 140 grand. But after the 6th of April 2026, under the 18% rate, it becomes 180 grand. That's a 40 grand extra tax cost just from timing. Add in the anti-forestalling risk if a contract is prematurely structured, and it's clear timing and structure really do matter here. The BADR change in April 2026 is not just a slight tweak, it's a meaningful shift that could significantly affect business exits and share sales. If you have an exit or sale in mind in the next few years, now is the time to plan for it. If you'd like help working through your specific position, feel free to reach out, send me a message, comment below, and I'd be happy to have a chat with you about it.